The bond market just screamed a warning that could wipe out the entire year's gain for tech investors. And if you were ignoring the 10-year Treasury yield crossing the psychological line in the sand, you are flying blind in a hurricane. Welcome back to the Prime Hour. I am Wall Street Prime, and tonight we are tearing down the facade of this rally to see what is actually holding up the floor. We are broadcasting live on this critical Thursday, December 11th, 2025, and the data we are seeing today is not just noise, it is a structural shift in how capital is going to be priced moving into the new year. Everyone is talking about the Santa Claus rally, but the smart money is looking at the bond pits, where the real story is unfolding.
Let's start with the macro landscape, because you cannot trade a single stock effectively without understanding the ocean we are swimming in. The United States 10-year Treasury yield has pushed up against that critical 4.5% level. Now, why does this specific number matter so much? According to our macro playbook, the 10-year yield is the global benchmark for the risk-free rate. When this yield spikes, it acts like gravity on stock prices, specifically for high-growth technology names. It is simple math but painful reality. As the risk-free rate rises, the discount rate applied to future cash flows increases, which mathematically lowers the present value or the valuation of those growth stocks. We are seeing a classic case of what we call sticky inflation. The market was pricing in a cooling scenario, a Goldilocks environment where inflation falls and growth stays strong. But the recent data suggests that the last mile of inflation is harder to kill than anyone at the Federal Reserve anticipated. This creates a nightmare scenario where the Fed might have to hold rates higher for longer, directly challenging the bullish narrative.
When we look at the dollar index, or DXY, it is currently flirting with levels above 105. This is a massive headwind for our multinational giants. A strong dollar above this level is detrimental to the earnings of big tech companies because it creates foreign exchange losses when they repatriate their overseas revenue. If you hold Microsoft, Apple, or Google, you are essentially shorting the dollar, and right now the dollar is fighting back. Furthermore, we have to watch the yield curve closely. We have spent months discussing the inversion, where the 2-year yield is higher than the 10-year, a historic precursor to recession. However, recently we are seeing a bear steepening, where long-term rates rise faster than short-term rates. This is not necessarily a sign of health. It is a sign that the bond market is demanding a higher premium for holding U.S. debt over the long term due to inflation fears. This macro backdrop sets the stage for extreme selectivity. You cannot just buy the index and go to sleep anymore.
Now, let's dive deep into the specific names that are moving this market, starting with the undisputed king of the AI revolution, Nvidia. The stock has been volatile, and investors are asking if the top is in. To answer that, we have to look at the valuation, not just the price chart. Nvidia is currently trading at a forward price-to-earnings ratio that seems high on the surface. But remember, the market buys the future, so the forward PER is far more important than the trailing numbers. The critical metric here, as favored by legends like Peter Lynch, is the PEG ratio. If we take Nvidia's PE and divide it by its expected growth rate, we are still seeing a number hovering near that 1.0 to 1.5 range. This implies that despite the massive run-up, the stock is fairly valued relative to its explosive growth. However, there is a caveat. We need to watch the inventory levels in the semiconductor cycle closely. Historically, when chip inventory levels peak and start to decline, that marks the bottom. But conversely, rising inventories in a slowing demand environment can be fatal. The bull case for Nvidia rests on the fact that their data center demand is not slowing down, but the bear case is gaining traction as fears of over-ordering by hyperscalers begin to surface. If you are long Nvidia, you are betting that the PEG ratio stays attractive and that they maintain their pricing power, evidenced by their insane operating margins. Moving on to the battleground stock of the decade, Tesla. This is not just a car company, and if you value it like one using standard automotive metrics, you will never understand the price action. However, the valuation reality check is necessary. We often look at EV to EBITDA for capital-intensive businesses like this. Tesla's volatility lately is driven by a conflict between its core auto margins, which are under pressure, and its AI and robotics narrative. The key metric I am watching for Tesla right now is free cash flow. This is the actual cash left over after they pay for all their massive factories and capital expenditures. It is the lifeblood of the company and the ultimate truth teller, distinct from accounting profits. The bull case is that Tesla is a tech platform, where the car is just hardware for software sales, justifying a high price-to-sales ratio similar to SaaS companies. But the bear case is ruthless. If demand for EVs softens further and they cannot monetize full self-driving quickly enough, that high valuation compresses rapidly because the growth denominator in the PEG ratio collapses. We are seeing a technical setup where Tesla is testing key support levels, and a break below could see a flush down to fill lower gaps, while a hold here confirms the long-term accumulation thesis.
Finally, let's talk about Palantir, a company that has become a retail favorite and a symbol of the data analytics boom. For a company like Palantir, traditional PE ratios are often useless because they are in a high growth phase where they reinvest heavily. Instead, we look at the price-to-sales ratio, or PSR. A high PSR of 10 to 20 times is acceptable only if revenue growth is accelerating. The moment growth slows, a high PSR stock gets slaughtered. The crucial KPI, or key performance indicator for Palantir, is their commercial revenue growth and something called the Rule of 40 in the software world. We also need to look at their net dollar retention and customer acquisition. In the software space, we specifically look for the annual recurring revenue, or ARR. If Palantir can prove that their commercial sector is growing exponentially to offset the lumpiness of government contracts, the bull run continues. However, the bear case warns that the valuation has gotten ahead of the fundamentals. The churn rate, or the rate at which customers leave, must remain incredibly low. If we see any tick-up in churn or a slowdown in the signing of new commercial contracts, the stock is vulnerable to a massive correction.
So how do we synthesize this for your portfolio strategy right now? We are in a market defined by the VIX, or volatility index. When the VIX is below 20, it suggests complacency, which can be dangerous, but a spike above 30 signals panic and often a contrarian buying opportunity. Right now, we are in a zone of uncertainty. The playbook is clear. Do not chase rallies blindly when the 10-year yield is rising. Focus on companies with high free cash flow yields that exceed the risk-free rate. Look for quality metrics like high return on equity, meaning the company is efficient with your shareholder capital. We are avoiding companies with high debt in low cash flow because in a higher for longer rate environment, refinancing debt kills earnings. Stick to the leaders who have pricing power and high operating margins. The market is giving us a test. It is testing our discipline and our ability to distinguish between a stock that is simply going up because of hype and a stock that is going up because the fundamentals justify the premium. Stay sharp, watch the 10-year yield like a hawk, and remember, in this game, price pays, but value creates wealth.